Welcome to The Deep Dive, where we extract the most vital insights from critical source material. Today, we are tearing into the Q2 fiscal year 2026 earnings conference call for Smith Wesson Brands. That's ticker SWBI, which happened just after market close on December 4th.
And this was easily one of the most pivotal calls for the company in the last couple of years. The stakes were really high.
High is an understatement.
Yeah.
I mean, leading into this, Smith & Wesson was just battered.
Totally. If you had looked at the stock over the last 12 months, it had dropped something like 20%.
Right, completely disconnected from that broader S&P 500 rally.
Exactly. They were fighting headwinds from, every direction. You had the post-pandemic correction in demand, you had inflation squeezing budgets, and this real uncertainty around tariffs.
So this call was their big chance, really their first chance, to prove that this new strategy, this pivot toward efficiency and innovation, was actually working.
It absolutely was.
And wow, the market's reaction told the entire story almost instantly. We're diving into a really unusual scenario here. Net sales came in at about $124.7 million. Now, that was a small beat on consensus, but it was still a 3.9% decrease year over year.
Right, so a soft top line. And if you only looked at that revenue number, you'd think, meh.
But the market went absolutely ballistic.
Because the quality of the earnings, that surprise and profitability, that was what mattered. Management reported GAAP and non-GAAP EPS of 4 cents.
And the street was expecting, what, 2 cents?
About 2 cents, yeah. So that's a 100% beat. And a beat like that, it just signals this dramatic operational tightening that investors clearly had not priced in.
And they priced it in immediately. The stock closed the next trading day at $10.96. That's a surge of 23%.
23%.
When a stock pops that hard on lower sales, you know the market isn't focused on the volume story anymore. They are placing a massive bet on a fundamental inflection point in the business model.
Precisely. We need to look at how they did it, how they generated those profits, because that's the real narrative shift here.
So let's get into it.
The absolute star of this report was the operating cash flow. It skyrocketed to $27.3 million.
And just for context, what does that compare to?
Well, to put that in context for you, that is an increase of about $34.7 million compared to the prior year quarter, where they were actually using cash to fund operations.
So they went from burning cash to generating a huge amount of it. That's a tremendous operational victory, especially in a contracting market. What was the specific lever they pulled?
It was pure inventory optimization. The CEO really highlighted their tight sales and operations planning, their S&OP process.
Okay, so that's basically how tightly they link production schedules to actual demand.
Exactly. They just stopped stuffing the distribution channel. They focused on running lean. They intentionally cut inventory across the board down to about $183 million from $196 million a year ago.
So it's like they stopped funding the growth of products just sitting in warehouses, and that immediately converted those assets right into liquid cash.
That is the perfect way to frame it. That tight focus converted what was essentially frozen working capital into immediately usable cash, a massive signal of financial discipline.
Now, we do have to acknowledge this discipline came with a margin cost, right? Gross margin did compress a bit.
It did. It came in at 24.3%, which was down about 230 basis points year over year.
And why the compression?
Two main things were at play. First, lower production absorption. They were deliberately running their factories slower to reduce that inventory, which makes your fixed overhead costs a bigger piece of the pie.
Okay, that makes sense.
And second, they had an 80 basis point negative hit that was driven directly by tariffs.
So the margin compression was really a strategic choice. They were prioritizing the health of the balance sheet and the cash flow over that short-term percentage metric.
Correct. And that choice allowed them to immediately put that cash to work. They paid their standard $5.8 million in dividends, which is great for shareholders.
And they tackled debt?
And they tackled debt. Critically, they had $90 million outstanding on their line of credit. And post-quarter end, they've already paid down $15 million of that.
So they're paying down debt while rewarding shareholders. That says a lot about management's confidence in future cash generation.
It speaks volumes.
Okay, let's pivot from the balance sheet and dive into the strategic narrative.
Yeah.
This is the why. This is why the market placed that huge 23% bet.
Right. Innovation, pricing power, and real market share gains. This is the long-term story.
And the core promise of this new strategy is that they can command premium pricing through innovation, instead of, relying on promotional volume wars.
And that strategy is clearly working. New products contributed nearly 40% of their sales. It came in somewhere between 38.7 and 40% of the top line.
40%, that's huge.
It is. That continuous pipeline is their shield against having to rely on heavy discounting.
And we see that translated directly into their pricing power. The overall average selling prices, the ASPs, were up 3.5% year over year. Handguns, which is their biggest segment, saw ASPs rise about 2.1% to around $418.
But the real leverage was in long guns. ASPs there jumped 10.2% to roughly $602. That is incredible pricing strength in what is, a normalized, non-peak market.
It absolutely shows that consumers see these new products as higher value. But the key data point, the one that I think convinced investors this wasn't just cyclical noise, was the market share data.
This is so important. We have to clarify this for the listener because the difference between what they shipped and what consumers actually bought is the crucial takeaway.
Let's do it.
Okay, so management was very clear. Total firearm unit shipment into the channel was up 3.3%. Solid, but not spectacular.
Right, but they were deliberately pulling inventory out of that channel.
Exactly. So after you adjust for those fluctuations where distributor inventories actually decline, the handgun retail sell-through, what people bought at the counter, was actually up a sharp 7.7% year over year.
So just to simplify, they stopped stuffing shelves at their distributors, which freed up their cash flow. But consumers walked into stores and bought almost 8% more Smith & Wesson products than last year.
That is pure hard-won market share.
In a down market.
In a down market. Remember, the overall market, based on the adjusted NICS data, was actually down 2.7% during the same period. For SWBI to grow their retail sales by that much while the total market shrinks is a powerful proof point for their strategy.
And now they're perfectly positioned for the seasonally strong back half of the year because their channel inventory is, as they described it, very clean.
Which means they can quickly convert any sudden spike in demand directly into new shipments. There's no stale stock to clear out first. This sets the stage perfectly for the forward guidance.
Which, while it was measured, it definitely confirmed that trajectory. For Q3, management expects net sales to grow 8 to 10% above the prior year's Q3.
And critically, they expect the margin story to improve right alongside that volume.
Yeah, they're forecasting Q3 gross margins to increase by a few percentage points, both sequentially and year over year. They also signaled Q4 will be the strongest quarter,
projecting high single-digit to low double-digit growth over Q3, driven by seasonality and, again, new product launches.
We should pause on the operating expense side, though. While OPEX was a bit lower year over year, management flagged a pretty significant sequential jump for Q3.
A very significant jump. They project OPEX will increase about 15% sequentially.
That's a notable step up. The drivers are costs for the annual SHE show in January, new product development, and increased profit sharing. But I have to ask, is the market sure this spending will translate directly into more success?
It's the key scrutiny point. For now, investors are willing to overlook it because they believe the new products are working. The market is budding this OPEX surge, is productive R&D and necessary marketing, not just bloat.
But if those new products stall in Q3, that 15% sequential increase is going to look very defensive.
It absolutely will.
And what about that tariff drag? The 80 basis points of margin hit in Q2. Does that stick around?
Yeah, management was pretty transparent that the tariff drag will pick up a little bit in the second half as they burn through their pre-tariff inventory.
But they don't think it's a major problem.
No. They were confident it wouldn't materially affect profitability. They're counting on the higher volume in Q3 and Q4 with more operating days and better production absorption to mostly offset that cost.
Okay, so let's address the elephant in the room, that 23% valuation spike. Management is guiding for solid, measured growth. But the market has clearly priced in a much stronger inflection. What's the risk there?
Well, the risk is obvious, right? If any element new product launches, the seasonal bump, margin recovery, if any of that falls short, the stock has baked in disappointment.
And a reward.
The reward investors are chasing is that narrative shift. They're betting SWBI has permanently moved from being a volatile, cyclical stock to a more durable, cash-generating, innovation-driven brand.
Speaking of brand, we have to spend a moment on a key strategic development, the Smith Wesson Academy.
This is a huge long-term ecosystem investment. They just had the grand opening of their new training hub in Maryville. It's run by a retired U.S. Navy SEAL from SEAL Team 6.
So this is more than just a shooting range.
Oh, way more. It offers tailored situational training, not just marksmanship. It's a crucial move for brand reinforcement. It deepens customer loyalty, especially with law enforcement and serious consumers.
And that matters for valuation.
Why? Because when you invest in training and create this holistic brand experience, you move beyond being a commodity seller. You create emotional lock-in. And that can translate directly into maintaining those higher average selling prices we talked about, even when the broader market is soft. It's a mechanism for sustaining premium pricing power.
Got it.
Now, we must transition to our purely theoretical segment.
Right.
This is for entertainment and discussion purposes only. What we're about to discuss is highly speculative and is absolutely not tailored financial advice for you, the listener.
Understood. Trading on this information could lead to immediate financial loss.
Yeah.
We're treating this purely as an exercise in market structure analysis.
Exactly. So we observed heavy options activity post-earnings. There was significant trading showing confidence that the stock has established a new floor, particularly around the $8 puts expiring in December.
And on the other side, aggressive players were buying out of the money calls.
Right, notably the $11 strikes. So if the market truly believes the new strategy has put a fundamental floor above $8, we can use that.
So the theoretical trade idea is a leveraged bullish bet structured to capture that aggressive upside if Q3 and Q4 really confirm this inflection.
The proposed theoretical structure is a synthetic long position. You'd be buying those out-of-the-money $11 calls, but you'd help fund it by selling the $8 puts expiring December 19th.
So selling those puts generates premium. You're essentially betting that the massive post-earnings rally created a floor that will hold above $8, and that premium helps pay for the aggressive call option.
The thesis is the short put generates the capital needed to capture the high leverage upside of the long call. If the S8 show in January and the strong Q3 guidance confirm the turnaround is real, that $11 call option could deliver significant returns.
It's a trade that assumes the strategic inflection is real and uses the market structure to reduce the cost of the upside bet.
Exactly.
Okay, so bringing it all back to the big picture. This deep dive confirmed Smith & Wesson's second quarter was defined by strong operational execution, impressive cash flow generation, and genuine market share gains. The narrative shift is real.
And a key structural component to watch is that investment in the brand ecosystem, like the new academy. For that 23% valuation spike to truly stick, SWBI needs to prove this brand initiative can generate measurable returns beyond just goodwill.
We need to see evidence that the academy is leading to higher sustained ASPs and deeper customer loyalty in a really volatile industry.
We'll be watching for confirmation on those operational leverage assumptions in the Q3 report.
Absolutely.
And here's a final provocative thought for you to explore on your own. Given the strength in pricing and their reliance on new products for nearly 40% of sales, how much more pressure can SWBI put on their premium price points? That tension between pushing for higher ASP growth and maintaining overall market unit demand will be the defining factor for their long-term stability as we head into the traditionally strongest Q4.